Before we begin, I just wanted to congratulate Mr. Ananth and the entire management team for a brilliant Q4 performance and wish them the very best for the coming quarters. We have the senior management of QME here with us, Mr. Ananth, Managing Director, Mr. Padmanabhan, Chief Financial Officer, and Mr. Chandramouli, Senior General Manager, Investor Relations. I won't take too much time. I'll hand over the floor to Mr. Ananth for his opening remarks, post which we'll open the floor for Q&A. Thank you, and over to you, sir.
Yeah, so good afternoon, and ladies and gentlemen, it's a pleasure talking to you all. So before we begin, as a practice, we will now have Mr. Chandramouli read out our disclaimer, and then I will take the call.
Good morning, I'm Chandramouli. During this call, we may make certain statements which reflects our outlook for the future or which could be construed as a forward-looking statement. These statements are based on the management's current expectations and are associated with uncertainties and risks are more fully detailed in our annual report, which may cause the actual result to differ. These statements must be reviewed in conjunction with the risks that the company faces. Thank you.
Yeah. Thank you, Mouli. So before I start, I sincerely hope and wish that every one of you and your families and friends are safe. I know that there are terrible stories that we are hearing from all over India, whether it is in Mumbai or Delhi or Bangalore or now even in Chennai. I do sincerely hope that we have a control on this very quickly, and then we move on. Okay, so I would like to start with giving a context to the year. All of you well know that the beginning of the last year, honestly, was started off a year in FY20, FY19-20 with a very poor other performance and a lot of uncertainty regarding the BS6 and the insurance costs, etc. And we saw a significant slowdown in automobiles. And while we thought that the subsequent year, which is 1920, would be better, we were hit in March with the pandemic, right? So early that year, we heard about the SARS-like virus spreading in China, but subsequently in March, when we had the pandemic announced and then the lockdown implemented, all of us went into a complete shutdown. So unlike many of the others, King's plants also were shut down, and progressively we started operations sometime in June, July. So we had effectively lost about a couple of months of sales while we had to absorb costs. So progressively the plants resumed operations, crossed over 50% utilization in Q1 while dealing with labor shortages, and also the utilization levels were not so great. Among our businesses, the minerals business was the first one to come back, or rather start off after the lockdown lifted or the lockdown lifted in a partial manner. The joint ventures and subsidiaries were more resilient, as I would believe, while the businesses, the largest businesses, which is the abrasives business, picked up a little later than the other two businesses. So while the ceramics business, which is a largely an export-oriented business and more a B2B business, and the electrominerals business, which riding on the shortages that were coming in from China because of their lockdowns, picked up faster. We saw the abrasives business starting up a little late, and subsequently in September, October, when all the festive season demand grew, our top line also started growing. We also saw during the same time the auto component, construction, the home renovations, all of them beginning to pick up. So abrasives did start doing well right from that period on, and a combination of both the mass market segments which were largely the engineering, the construction, woodworking, and the precision segment, which is driven by the auto component, started doing well. Sometime in November, December, we also saw the beginning of the second wave in Europe and other parts of the world as well. US, Australia a little bit initially, and also, of course, Russia. So many of these countries did have their own versions of lockdowns, with the US and Europe in a much more stringent fashion than the others. While that happened in outside the country, we saw the domestic market continue to do well, and most of us thought, the pandemic is behind us. And all of us were also very positive when the governments announced a slew of initiatives like the PLI schemes or later on we also saw the union budget giving a big infra push. So that was a big positive news for the entire country. And at about the same time, we also saw a much faster rollout of the vaccination. When I say much faster rollout, our expectation was that the vaccine will come later, but the fact that it came a little ahead of time was also very big positive. So while we were all looking at these things, now we are hit with the second or third wave, and we have now become the worst affected economy in the world, or country in the world. So that is where we are coming from, and our performance should be seen in that context. So, as year 2021, while it has been testing on so many fronts, it has also taught us a lot of lessons and how to manage in a virtual world. The business managed to record a 1.4% growth at the consolidated level and a 1.6% growth at the standalone level. So we had the PAT growing by about 4.5% at the console, whereas at the standalone level it declined marginally by 2%. Now, if someone had told me that these are the numbers that we will look at, at the end of the year, when we set out our scenario planning in April, May, I would have gladly taken it. That's the kind of situation we were in Q1, where we did not think that this demand will come back so fast, and we will be able to do these numbers. So overall, the standalone businesses drove the top line growth, and the subsidiaries drove bottom line growth. So while we saw that the pent-up demand coming back in Q3, in Q4 we also saw another set of challenges, which is basically on shipments, delayed shipments, containers not being available, the commodity prices going up, raw material prices consequently going up. So these were uncertainties and ambiguities which plagued us in Q4. But there has been a visibly higher demand in the electromineral segment over the last year. Now, the company level growth we see in sales at the standalone and the console came from the mineral segment. So not only did it help us overcome the slowdown in other segments, but also helped record overall top line growth. The abrasives segment managed to remain flat at the standalone level. So this coming from a slow start. So what we have seen in this segment is a dramatic shift in the pattern of sales between quarters. So the overall volume of sales did not come down, and we were able to maintain FY20 levels. However, the performance of our overseas entities, the abrasive segments, both at America and Russia, was impacted by their domestic markets and their lockdowns, which impacted their auto component businesses. So consequently, their top line saw a marginal decline. But the big positive, I would say, in this segment has been the profitability. So while we had a flat top line, the operating profits grew 19% year on year. So we had taken a slew of measures, cost controls, both on the material costs and on the efficiencies and on the fixed costs, which has helped us clock double-digit growth rates. And towards Q4, a more favorable product mix in terms of higher precision addresses also helped. Obviously, many of the expenses-related travel, communication, exhibition, etc. came down, and that has also helped. So these are what I would call possibly one-off. But this year also it seems like many of these costs will not be incurred if situation continues like this. So the margins in the segment improved by about 300 basis points. Now going into FY22, the focus will be to retain some of these structural changes in costs. We know some of them will come back, and the investments that we have made in automation and mechanization has to start paying off. Electro Minerals has seen a very good performance this year. At the consolidated level, the business grew by 4% in top line. Here it is pertinent to say that our Russian subsidiary VAW, though was impacted by the COVID, the plant and the market there continue to do well throughout the year. They churned out the volumes. They did not have even a single month of slowdown, so they managed to keep their material moving. It also helped that they came under the essential services or essential materials in their geographies. So standalone growth was higher at 7%, and this segment was one of the earliest to see revival in demand. And this is also due to the fact that some of the export customers seeking to deals from China and also domestic customers who were sourcing from China were looking at local opportunities or opportunities to source from India or local opportunities. So this segment has seen a strong demand in white fused alumina and silicon carbide. Realizations has also been strong. But as in all segments, we have been facing input cost pressures here too. So what we are seeing is a 30% growth in consolidated operating profits and a 46% growth in standalone operating profits for a single-digit top-line growth. And it is not just a story of volumes here. Very active business development, ensuring that we address markets which we are not being there before. And this is evidenced by the high volumes in specials, efforts at fixed cost reduction, and the variable costs have also led to these record growth figures. The ceramics segment had a very mixed year. In the technical and engineering ceramics, we saw record volumes. They did much better than ever. Metallized cylinder volumes also recorded very good growth, and we have completed the expansion activities in this line. The other major breakthrough this year is the entry into the electric vehicle component space. So for the electrical parts of EVs, we have started our supplies. So that's a good good initiative which has been started, and we're looking forward to growing in this space. However, the wear ceramics and the refractories performance was relatively muted. This was largely due to the project deferrals in core sectors, and hopefully the project orders will come back this year. Because we believe that these plants, these process plants which are heavily dependent on these kind of materials, would have taken up only a repair job or EOR job as we call it, but definitely the project orders are due this year. But on the positive side, the wear ceramics or the wear materials part was able to onboard new customers in repairs and maintenance space. Especially many customers have had to start and stop operations intermittently, and this led to more wear and tear. Overall, the consolidated segment declined by 0.3% and the standalone businesses declined by 2%. But despite this, the PBIT grew by 3% at consolidated level and a much higher 6% at the FCA level. So the lower fixed costs, higher volumes from continuous process lines, and a more favorable product mix helped the standalone profits. In Australia's performance, that is this part of the wear ceramics, is impacted by a host of factors, which included a setback to the domestic iron ore industry as political tensions between China and Australia were escalating for a while. So this business has seen a 5% decline in top line. The ceramic segment of Russia subsidiary VAW was a real success story, and we have been seeing strong growth in the nitride bonded silicon carbide refractory space, which goes into the non-ferrous industries. We have also been putting up capacities here and added another kiln earlier this month. The ceramic portion of Kim America and Kim Middle East also saw growth and also kind of negated domestic softening to some extent. In American markets, we have made some breakthroughs in the mining sector over the last year, and that augurs well for the future. At the full year level, all entities were in positive margins, except for Foster Zirconia. But to the credit of Foster Zirconia, they have halved their losses from last year's levels, and the lower losses come over a 30% growth in top line. So also in Q4, we saw positive margins. A quick look at the other subsidiaries. We have Sterling Abrasives, is the other success story over the year. It's in Ahmedabad. So this business has grown by almost 9% this year and saw volume growth both in agri and industrial segments. Kim Middle East grew about 20%, while China also did very well. Profits were also positive. Overall, the share of profits from JVs was lower by about 15%. So Morgan Thermal Ceramics and Vent performed very well and recorded growth, but Chiria, which is more a project-based business, had a very tough year. And on top of it, it comes over a higher base of last year. Therefore, to sum it up, what we're looking at is a consolidated growth, sales of 2,604 crores, which marks a 1.4% growth, and a 284 crore PAT, which marks a 4% growth. Capex over the year we spent about 103 crores, standalone with about 56, and Russia with about 40 crores. And some expansion capex we started before the pandemic has also been completed this year. So these include the second line equipment plant and the new facilities in composites and expansion in the metallized cylinders. We also have commissioned the third silicon carbide facility in the ceramics business. Going forward into FY22, we have a few more capex planned, and both in India and in Russia, and we will continue our cost and volume focus. Our CFO, Mr. Padmanabhan, will talk more about this, and our balance sheet position is also very strong this year, and we have been able to keep receivables well under control and maintain the net working capital. So this closes my briefing for the quarter, and now request our CFO, Mr. Padmanabhan, to take you through the numbers, following which we can open up the forum for questions.
Thank you, Anand. Good afternoon, everyone. Let me summarize the financial performance for the quarter and the year ended March 31, 2021. The consolidated sales for the quarter has increased by 28% from 586 crore to 756 crores. Of this, the standalone had increased by 147 crores, thus signifying a 41% growth over last year. The consolidated segmental PBIT was at 138 crores in Q4, which was up from 94 crores in Q4 of last year, signifying a 46% growth on a quarter-on-quarter basis. At the standalone level, the segmental PBIT for the quarter was at 84 crores, against 52 crores, denoting a 63% growth over Q4 of previous year. On a consolidated basis, profit after tax and non-controlling interest for the quarter was at 90 crores as compared to 92 crores in the corresponding quarter of last year, a 2% decline. At the standalone level, the PAT decreased to 58 crores from 62 crores, showing an 8% decline on a quarter-on-quarter basis. The margin level, the PAT margin degrew from 16% during last year at the consolidated level to 12% in the current quarter. At the standalone level, the margins have come down to 11% from 18%. And on the abrasive segments, the consolidated sales for the quarter increased from 213 crores in the corresponding quarter of last year to 300 crores this Q4, indicating a growth of 41%. Standalone sales increased from 174 crores to 253 crores in Q4, denoting a 46% growth. At the consolidated level, the PBIT was at 50 crores. This is up from 23 crores, 119% growth, out of which 22 crores increase is from standalone and 4 crore increase is from our domestic subsidiary, Sterling Abrasives. Moving to electromineral segment, the electromineral segment's consolidated sales for the quarter increased to 290 crores from 251 crores in the corresponding quarter of last year, denoting a 15% growth. At the standalone level, sales increased to 137 crores from 101 crores in Q4 of previous year. The standalone South African subsidiary and Russian subsidiary contributed to the top line growth. The consolidated electrominerals business recorded a PBIT of 42 crores against 32 crores in the same quarter of previous year. This indicates a 31% growth. The standalone contributed 2 crores to the increase in profitability, while the Russian and South African subsidiary showed strong results. Moving to the ceramic segment, ceramics consolidated sales grew by 36% on quarter-on-quarter basis from 140 crores to 190 crores. The standalone sales grew by 28% on quarter-on-quarter basis to 149 crores. The net sales of our Australian subsidiary grew by 23% on quarter-on-quarter basis. Consolidated PBIT of the ceramic segment for the quarter was at 48 crores, higher by 6 crores from the same quarter of last year. The standalone profitability increased to 33 crores, denoting a 38% growth. And as Mr. Anand said, the balance sheet is very strong and we have good cash position. There is no debt in the standalone books as of March, and in Q3 also we don't have anything. On a consolidated basis, also the liquidity position and the financial position is strong. The debt equity ratio was at 0.02% in March. The total debt on consolidated basis was at 43 crores, and at the net level it is 647 crores. Then to comply with the minimum public shareholding requirement, we divested 2.47% of our equity stake in our associate company Vent, and this has resulted in a profit of 13 crores during the current quarter. On the forex cover, CUMI is typically a net importer in dollar terms and a net exporter in euro terms. We cover the net exposure as appropriate in accordance with the forex policy. And this is the update from the finance side.
So shall we start the question and answer session now?
Yes, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue is done. The first question is from the line of Bhavin Vithlani from SBI Mutual Fund. Please go ahead.
Yeah, thank you for the opportunity and congratulations to the management team on an excellent performance. So my first question is, if you could help break the ceramics segment into refractories, med cylinders, wares, and others, and how do you see the outlook of this? In your opening remark, you mentioned about EV batteries and fuel cells also as an opportunity historically. So how should one think about the ceramic segment on a 3-year perspective and also on the profitability of these segments? The second question is on the abrasives. Last year, similar time, we had a new facility of coated maker commissioning which doubled the capacity. So given the current situation, without further capex, what is the kind of revenue that we could see from the abrasives facility? Yeah, these are my two questions.
Okay, on the ceramic facility, broadly we have what they call the thermal part of the business and the technical ceramics, and we also have a smaller composites business, which addresses both the wear and the corrosion resistance or anti-corrosive business opportunities. On the technical ceramics, as I said, it's largely an export oriented business with customers in the vacuum interrupter tubes space, which is for the high voltage power transmission, and also in the alternative energy business. So both these segments are doing well, and the outlook for the current year, which is the FY22, and at least going forward over the next couple of years, is positive. So definitely this is one area where we will continue to invest and create capacities. So the capacity expansion, what we set out in the middle of the pandemic by installing a new furnace, which was commissioned earlier, late last quarter, and then stabilized earlier in this Q4, is now ready, and that is something which we look forward to in the coming year. As to the thermal part of the business, it is more a project-oriented business, and with the which I believe there are two things which come into play here. One, I think the inclination now and the intention of many of the players in whether it is in the steel industry or the truck industry, to source from local sources. I think that we are seeing going on an increase, which means there are opportunities for the refractory segment to replace competition from mostly from China and other parts of the world. So while we are focusing not on the day-to-day consumable refractory, we are focusing on the design, the bespoke solutions which we offer to customers across various segments. We also see an opportunity to leverage that and grow in global markets. So whether it is the glass, the cement, carbon black. So these are all opportunities not only in India now, but also growing across the globe. It is still early times, but then with some of these segments in the PLI scheme getting a seal of approval and hopefully investments coming in these areas, specialty steels, for example. So refractories would, especially on the specialty steels, where more of investment casting, high purity alloys, etc., will come into play. This is something which we are looking forward towards a growth area. On the subject of margins, I would believe that the industrial ceramics part of it would largely continue to stay at these levels, plus minus a percentage. But the refractories and the composites would be marginally better, because the reasons it's a product business. Once a product business comes in, it is a much better position than a consumable day-to-day refractory business. On the abrasives, we did invest in the maker in March and got it commissioned last year during the pandemic, and I'm happy to say that the capacity utilization of that maker has been at a little better rate than what we thought and set out at the beginning of the year. So while the capacity expansion of the coated maker, the capacity utilization of the coated maker is ramping up, and that will definitely drive growth this year. We are also supplementing that with investments in the conversion part of the coated business, whether it is sheets, belts, discs, etc. So that is what is going to drive growth in coating.
Sure. So just one follow-up, if I may. With the current investments that we have, historically you had mentioned that we could do a revenues of about 4,500 crores and about 11-12% at PAT margins. But we have seen increased price level. So with the current increased price level, would it be fair to say 5,000 crores revenue potential from the current capacities? Would that be a fair assumption over a 3-year period?
With price levels, yes, last year in some cases, some product groups had increased price levels. But these are commodity prices, so especially in the minerals business, prices can fluctuate a bit. I would say that region would be fine.
Yeah, thank you so much for taking my questions and best wishes.
Thank you so much.
Thank you. Participants, to ask a question, you may press star and 1 now. The next question is from the line of Kriti Jain from Sundaram Mutual Fund. Please go ahead.
Yes. Congratulations, sir, for an excellent performance, and
Thank you.
Trust you are doing well. So my first question is, we have seen a very good cash flow from QME. We are now sitting on a roughly 700 crore kind of cash pile as compared to a debt neutral status 2 to 3 years back. This year again, since our capex in the existing businesses can take care for the thing, so we will again have a 400 crores kind of cash accruals which we will have. So with these kind of cash accruals, where will be the money invested? So like we will have at the year end 1100 crores. Where will the money get invested?
So the last year was a year where we want to conserve cash. We just did not know what can crop up, what can come around the corner. So we had to be extremely careful. We prevent about those spends. And I think this year is proving to be no different or very different, but of a different degree altogether. So yes, cash is important, and that is something which we value, and we will continue to build on those reserves. As for the investment, we definitely have plans to grow in organic manner. There are segments, there are areas where the growth potential and the profit potential are in line with our corporate guidelines, and it is in those areas that we will invest. Obviously, the ceramics part of the business is one area where the resource allocation would be higher. We also know that we have opportunities, and we can grow in the abrasive space only through inorganic acquisitions across the globe. So that being a very business of a global nature, and we having already a good brand position in Europe and the US, growing inorganically is the way to grow for abrasives. So that is another area of growth. It is just not only for the top line, but also in the case of abrasives, it should add to our portfolio, to our range, technology and market access. So these are some of the criteria that we have for choosing our targets. We also looking at investing in areas of advanced materials. There are materials which are possible materials which we are not currently in, but these are materials of the future, and some of them are in the thermal storage space, and they have a wide range of applications, including whether it is in food storage or in pharma, vaccine deliveries, etc. So these are temperature storage materials that we would be investing in. So areas where we have what do they call, a material science flavor at the same time, which makes sense to us strategically. So that is the area of growth.
Sure, sir. So secondly, sir, like we are seeing crude going up, like petcoke is our one of the material. Aluminum is going up. Aluminum is our material. Sir, are we intending to take other price increases and will we be able to meet the cost inflation and maintain the margins in the abrasive segment, sir? Or in the ceramic segment?
Yeah. So we saw this in Q4 where commodity prices have definitely started going up. And I mean, if there is only a certain amount of prices, the cost which we can absorb, work on our efficiencies and absorb costs. But if it has to be passed on to the customer, we will have to do it. So that we are seeing that happen as we speak. So there are selective price increases already happening.
Okay. Sir, lastly, just one bookkeeping question, sir. What was the one-off loss which, just for CFA, what is the one-off loss expense which you had written off this quarter, sir? That's the only thing I wish to know.
Prabhu, you want to answer that?
Yeah. This is in compliance with the Indian accounting standards. The fair valuation has been done in respect of the financial instruments, and that is why the provision has been created. And it is netted off against the income from the part stake sale in Vittimarketsapp, and the balance net of around 11 crores has been shown.
Okay. What is the instrument, sir?
The instrument is as per the Indian accounting standards, we have to fair value each and every line item of the asset.
Okay.
Like that, we have done the financial instrument in the consolidated level. At the consolidated level, we'll move to the standalone level also. Similarly, we have done, and then we have taken this provision. It is, like each and every year at the quarter end, we have to revalue, and then the movement has to be done either through the profit and loss account or through the OCA account. If it relates to the current period, then it has to go through the profit and loss account, which has been done during the current quarter.
Okay, sir. Thanks, sir. Thanks a lot, sir.
Thank you.
Thank you. We would like to remind participants that you may press star 1 to ask a question. The next question is from the line of Charanjit Singh from DSP Mutual Fund. Please go ahead.
Hello, sir. Good afternoon.
Good afternoon.
Yeah. So, on the top line front, if I see on FY19 versus FY21 how we have delivered, so it's kind of 3.5% kind of a growth. And now with a lot of these drivers coming like PLI or even the manufacturing overall intensity expected to go up. So where do you think that the growth rates, once this situation of COVID stabilizes, how industry can grow and versus the historical growth rates?
See, the PLI schemes and the infrastructure spend announcements in the budget, both are definitely good drivers of growth for the company. And if I were to pick on a few areas, initially it was about 10 schemes which the government had said, and then added on another 4 schemes. But then not all the schemes have been approved yet. So we are hopeful that these will kickstart. For example, in the areas of auto components, the idea is India can be a very big global player, and if that happens, then autocom would require the abrasives and also the foundry segment to do much better than what it is doing. So those are opportunities, whether it's for abrasives or for the factories and also for the minerals part of the business. But that is still not being finalized yet or approved yet. Things like the advanced chemistry cell batteries, again, where the plants are in terms of big investments. So that has not happened. But we are preparing for that. So we have materials like the graphene and the high performance graphite being qualified by potential customers. So we will be ready for that kind of change when it comes to opportunity when it comes to. Similarly, on the electronics manufacturing space, whether it is through engineered ceramics or the high purity silicon carbide, which can go into the 5G chips, so high purity silicon carbide as single crystals. So these are areas which our teams are in Russia and in India are already working on. So we have been able to hit purities of 99.99 plus. So it is just a matter of time before we hit those desired purities and be ready for those industries. In terms of whether I was talking about pharma, food delivery, so materials like the face change materials. So they are all good materials, science products that we can have for the life schemes. Telecom, whether through composites and again silicon carbide.
Mr. Anand Session?
Hello.
Hello, sir.
Yeah.
So this is your speaker. I'm checking the line of Mr. Anand Session, sir. Just give me a minute.
Yeah. Hello. Hello, am I audible?
Yes, sir. Now it's audible, sir.
Okay, sorry. So in many of the PLI schemes, we have a play going. It all depends on how soon these capacities will come on stream or the players will come on stream. But we are readying ourselves with those product lines.
Okay. And sir, on the margin front now, last 3 quarters, we have seen a that margin. There have been a lot of cost savings. And you rightly mentioned that there are a lot of costs which may not occur in this financial year, but they will definitely come back. So from a sustainable margins perspective, we can touch upon like how we should look at sustainable EBITDA margin. And within different segments, especially, abrasives, we have seen again EBIT margin, jumping to almost more than 15%. And what has been the driver for that? And even for ceramics, can we sustain at these levels what we are, currently delivering at more than 20%?
Yeah. See, the profit margins on abrasives is not a standalone event. I think it's been a systematic improvement in the abrasives margins and the kind of work which the teams have been putting in addressing costs in a much more scientific manner has been paying off now, I would believe. And yes, some costs will come back, and possibly a percent and a half could be the kind of costs that we will not, those kind of savings we will not see. So I would possibly believe a 15 and a half kind of margins will be more sustainable. Specifically in Q4, what also happened was that we had a significant improvement in product mix. So with the automobile industry picking up steeply, then we saw the precision abrasives requirements going up. So that being a very custom-built business, obviously the realizations and the margins are better. So that definitely kind of also took some of the shock from the raw material price increase. As I said, the coated abrasives, the capacity utilization of coated abrasives and the kind of volumes which we are able to churn out, plus the fact that the new investment is also more efficient, helped us save some costs. But that is definitely something which is a sustainable cost. So going forward, I would believe that when the capacity utilization of the coated maker growing, we will be in a much more competitive position than we are today.
Okay. So, sir, and so you mentioned that abrasives will be in the range of 15 to 15.5%. Is that a correct understanding?
Yeah.
And on ceramics and refractories, how do you see a sustainable margin here?
Ceramics, I would believe around the 20% margins that we currently have would be a good base to have.
Okay. And electrominerals also have seen quite a lot of variability on a quarterly basis on the EBIT margins. So if you can touch upon that, what is causing so much variability, and do we think that the pricing, which we wanted to see in improving because of China-related issues, we can see that sustaining and the margins can remain at a sustained level of 13-14%?
See, I would say for the standalone minerals business, the desire is to get closer to the 13-14%. But the fact is that they did move quite a bit from where they were last year to now, which is almost doubling their EBIT margins. Having said that, the Q4, the drop in margins in Q4 was due to a couple of factors. One, an increasing move towards the refractory industry, because the volumes in the refractory industries today are much higher, and that is where most of the customers are importing material from China. So we have been ramping up our volumes in white fused alumina segment, and that has given us a definite push to the top line. But the contributions or realizations are not as high as what we would get from, let's say, a specialty sector like abrasives. So while the overall contributions may drop, we would still find that the EBITDA can be higher. But in the case of abrasives, in the case of minerals in Q4, all of you know that a significant portion of cost is power. And in the month of the period of Q4, generally we have a very low generation from our own power plant, so that has impacted costs a bit. Plus, the cost push which came onto the raw materials, we have not been able to pass on in the same month, in the same quarter. So, which is what we are now doing in subsequent quarters. So, I would say that in the electro minerals segment, especially in standalone, I would say targeting between 11 to 13% would be a much more reasonable margin targets to take.
Okay. Great, sir. Thanks for taking my questions. I'll circle back on the queue. Thank you.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The next question is from the line of Sanjay Dam from Old Bridge Capital. Please go ahead.
Thanks for taking my question, sir. Congratulations.
Thank you.
Yeah. So, sir, if you could give us some brief comments on market share gains. A couple of quarters earlier, you said that there have been certain gains in most of the segments that you operate in, especially the abrasives. Have there been more consolidation and gains after that?
The numbers what we saw in Q3 and then definitely indicated to market share gains in the mass market. So there has also been definitely a drop in imports in some of the segments where we play in, and that has contributed to this market share gain. So if I were to see the Q4 numbers as well, that trend seems to continue for two reasons. One, the imports from China traditionally in the month of February, March would be lower because of their new year, and some of the shipments are still continuing to be delayed from China. So there is definitely a good chance that we would have gained market share in abrasives.
Thank you, sir. Secondly, sir, in FY21, our capex and depreciation were by and large balanced. And going forward, you said in refractories possibly will create some capacities. So in the next couple of years, the capital allocation that you see organically, any ballpark estimates, sir?
So we last year when we set out the plans, we had taken a capex of, if I remember right, about 150 crores around that. And then during the course of the year, we kind of looked deep into those critical capexes that we must do, and that's what we did. So we ended up the year broadly around about 203 crores, and obviously that is not a very what they call a good way to drive sustainable growth. So we need to put in growth capex, and we have made our plan this year to do about between 150 to 170 crores across the company, across consult. But having said that, again, we did not see, when we put on these plans, we didn't see this third wave of COVID or second wave of COVID coming. So we will definitely look deep again into what we should spend, but knowing fully well that those areas which the spend should happen will happen. Things like the industrial ceramics is definitely one area where a resource allocation will happen. There are projects in the electro mineral space largely for the conversion, because the fusion capacities are all in place. They can churn out volumes, but those huge volumes have to be converted into products, and for that capex will have to happen. We have capexes coming up for expansion in Russia, both on the furnacing side and also on the refractory side. So these will happen. In the case of abrasives, this time the coated abrasives, the conversion capexes, which was already planned but kind of planned for next year, will be advanced to this year because we see the capacity utilization of the maker coming up faster than we expected. So that conversion capex will happen this year. We will also be spending on the modernizing and upgrading of some of our bonded abrasives, presses, and films. So yes, wherever the vital and critical capex has to happen will happen. But broadly, currently, what we see currently is about 150 crores is what we are planning.
Thank you, sir. Thank you so much. Wish you all the best, sir.
Thank you so much.
Thank you. The next question is from the line of Manish Goyal from Enam Holdings. Please go ahead.
Yeah. Thank you so much, sir. Just want to clarify on the earlier participant where you mentioned we expect margins of 15 to 15.5% on a sustainable basis. And so basically that is, so just to correct myself, you mentioned that 1.5% of the cost saving what we saw during the pandemic time may not sustain, and that is why you believe that the margins can revert to our FY20 levels. But sir, on other side, like as you also mentioned that with the current capacity, we can go to say 5,000 crores revenue. What it implies is that we have enough operating leverage in place. Then sir, in that case, that is one, that we have operating leverage, and I believe like we have been looking to move towards higher value added products with especially in the ceramic space and with entry into EV battery space and solid oxide fuel cells, and I believe you have many more such products lined up. So I'm just wondering that is it very conservative that because we have ended up with 17.7% EBITDA margin in without other income in FY21. So just want to know why such a...
No, sorry. My answer was specifically for the abrasive segment.
Oh, okay.
Not for the company overall.
Okay. So overall, so can we expect that the margins what we have currently is more or less sustainable going forward, sir?
Yeah, I would believe so.
Okay. And so coming back to the 5,000 crore revenue, sir, so just want to get a sense that are we going to probably in next 3 to 4 years are likely to witness higher revenue contribution coming in for more value-added products, and which will in turn help us achieve our or achieve higher revenue growth going forward than to what we have seen historically? Do we see a fair degree of change in our product mix leading to a revenue mix change?
See, we would I would not completely go with that, because we are today very clearly, if you look at the minerals business, we are very clearly leaders in silicon carbide, and that is a for want of a different name, I would say a commodity business, right? It's a big volume, high realization business. I mean, high volume business. It is not. There are elements of value added products there, but definitely the bulk of the volume will still be for the mass consumption as a raw material. Same case in the case of fused alumina. So while we are about 1 lakh capacities or tons capacities in silicon carbide, we are looking to leveraging our existing capacities plus some bolt-ons to have a similar capacities in the fused alumina business. So the growth will come from regulars, as we call it, and also from the special, which is the high-end materials. Whether there's a high purity silicon carbide, graphites, graphene, etc. So it's going to be a mix of both. So one will give you the foundation, and second is possibly add on to the value going forward. In the case of abrasives, it's a very different story, where a bulk of it, at least 70% of what we are in today, is mass market, and that is where we will be going again. So that is where growth is. Infrastructure growth, housing growth in India definitely is coming from that segment, and we will be preparing ourselves for that. And of course, any opportunities that come along in terms of the PLI and the opportunity to grow in the position, both in conventional position and super abrasives is another area. So it is a blend of both what I would call a regulars and specials.
Sure. So ideally, with the capex of, say, annual capex of 125 to 150 crores over the next couple of years, we should be able to achieve that number in probably 3 to 4 years, sir?
Yeah, the capex would also depend on some of these projects which if you have to ramp up faster, so we need to put in a little more money there. But I would say that this is the range in which the capex will be.
Okay. And last question, sir, on microgrids. Earlier, we used to have a fairly high degree of sales and profitability from microgrids, sales to the solar PV industry. So are we seeing that product also doing well?
See, that product for the solar PV industry is declining, but what is happening is the same product is now being used in the semiconductor industry.
Okay.
So the semiconductor industry, both in Europe and in Japan, we are supplying. So we have the capability to supply the industry. And if that is going to come into India as a part of the PLI scheme, so we are well positioned.
Wonderful, sir. Thank you so much. Thanks.
Thank you. The last question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Yeah, thank you for the opportunity. Sir, could you give us an outlook for the super abrasives and for sterling abrasive, which is largely on the food and beverage side? How should one think about these companies over the next 2 to 3 year period?
See, sterling abrasives is a very a niche player in precision abrasives, largely catering to the rice processing, dal, atta processing segments. So it is I would believe is a recession-proof industry we are in. Because food processing, more and more of us prefer to buy food from the store, right? So dal, whether it is in all these pre-packaged foods, or atta, the growth is phenomenal. So I see the selling of abrasives going very well in the agro industries, both agro processing or food processing, both in India and in Southeast Asia. They also have a very good product portfolio for the industrial applications, some of it which complements what we do in chimney. So that's kind of a broad end of a portfolio, whether it is in the bearing industry or some auto component industries, and they have a good distributorship in markets like in US and Europe. So good prospects for selling abrasives in the precision industry. The next question was on the super abrasives. I think super abrasives is again globally many of the applications are moving into super abrasives largely because of the sophistication of the machines. If you want to have a more precise output plus a productivity, then super abrasives is possibly the tool of choice. So it offers a good range of products in diamond, in which for CBN, and along with CUNY. So CUNY and Vent together are working on a few products which complements each other. So that is something which we are very bullish about.
Yeah, thank you so much for taking the questions.
Thank you.
Thank you.
Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Aditya Bagul for closing comments.
Yeah, thank you. So a big thank you to the management team for patiently answering the question. I would also wish them all the very best and wish them for the quarters to come. Thank you so much.
Thank you. Thanks, Aditya.
Anand sir, if you have any closing remarks.
Yeah, my only closing remark is that, the entire last year, I was just talking to friends of mine, the entire last year was one of waiting for demand to come, right? So we were all figuring out, we were all feeling that sitting at home, okay, when will the demand come back? And when the demand came back, we all thought that this COVID is done and dusted, right? So today we are seeing a very new, different COVID. So the demand is still there. Technically, yes, the manufacturing lines are open, the factories are open, but then there is also a major fear factor in play. So while we are still very, very positive about the growth and the growth prospects, we should keep in mind that this situation has to be brought under control soon. And it is up to each one of us to play our part in keeping ourselves safe, keeping the people around us safe, and get ourselves vaccinated as soon as we can. So that is something which we are driving across the company. And for us, seeing the next couple of months through without any, I would say, fatalities in the organization is the prime thing which is driving us. So business will definitely follow. But ensuring that every one of our team members are healthy and safe, and wishing you also a very safe future and your families too. And looking forward to seeing you all soon again.
Thank you, sir.
Thank you so much.
On behalf of Axis Capital Limited, this concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.